Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
Alex, welcome to the podcast, mate.
Hey, Owen. Thanks for having me.
It's always good to chat. And today we're going to chat about something that's probably, I would say, it's easily the most popular topic that I've seen in our community for years. And it's one of those topics which I think really needs expertise to add and secure the value that this strategy unlocks in terms of helping people grow wealthy. I was chatting to a mate who's in finance and he's got a few $100,000 of equity in his home. And he's got finance guy, gets it, understands it, runs his own business, but never had heard of this as a strategy. And then you kind of crack the surface of the ice and it's just this whole thing underneath that you didn't realize was there. So I'm excited to get into it. And I know a lot of your clients at Everest do this. I've got a few icebreakers before we get into debt recycling though, mate. This, as you know, we start with a bit of fun. So any types of anecdotes or stories here add value. The first one is, what's one financial decision that you made that you wish you could take back?
Yeah, look, I saw this question obviously before we having this chat today, and I think there's been a few. I couldn't think of anything particularly humorous off the top of my head, so I'm going to go with a more sort of generic answer. But I think it is very applicable for a lot of people once they start building out their financial journey and stuff like that, which I obviously have as well. And that's really just probably not starting early enough. I think that's probably my biggest regret. I look at what I've managed to accomplish over the last sort of 6 or 7 years, and it's just I just started earlier. I've been in such a better position even more so. So, it's pretty generic, I know, but I think a lot of people, probably think like that as well.
Oh yeah, absolutely. Myself included. I was pretty lucky that I started early, but even still, I could have done more. I think that's one that everyone can relate to. Number 2 is, if you weren't a financial advisor, what career would you have pursued?
Yeah, so I had a bit of a think about this one. So I was actually pretty keen on being a dentist when I came out of school. I didn't quite have the marks straight out of school, but managed to get the marks sort of after the first year of uni. But then, ended up changing my mind and going into economics and commerce, and now obviously financial planning. So I don't know. And thinking about it now, I don't quite know why I would have done that. I don't think I would have actually really liked that at all. So I think if I wasn't doing financial advising, I think I would be something similar, maybe a coach or something, or I think a teacher would be pretty rewarding as well. Obviously get the school holidays, big plus there. So maybe something along those lines, possibly.
Yeah, cool. Well, you get to deal with people, same as a dentist does, I guess. So maybe that's some of it in helping people, which is always a good byproduct of any job. Final icebreaker, mate. What was your most recent investment?
So most recent, I dollar cost average into ETFs every fortnight. So that was my most recent investment on Tuesday this week. That was me at the moment.
Do you ever do any more speculative stuff, or is it all core, low cost, diversified type ETF type stuff?
Definitely done. I think as a journey a lot of people go on as they learn more, you realize you're not very good at picking stocks or anything like that. So I've definitely over the last sort of 5 years focused a lot more on really building that core up. But I do have a portfolio which I started many years ago when I was sort of dabbling and stuff like that, and I sort of let myself within that portfolio, invest in maybe a little bit more speculative things, or more sort of direct stocks and stuff like that. So able to take a bit more of a punt. I don't put any more money into it. I just, whatever money I can make off it, I allow myself to sort of reinvest that where I might be interested. And it's not all necessarily specky stuff. It might be thematic or something like that as well. But I do that in that portfolio, and then everything else is I guess a bit more level-headed, a bit more vanilla, I guess.
Yeah, for sure, man. I like it. And that's it. Yeah, awesome way to compound, right? So amazing. So we're going to be talking about debt recycling, about using leverage generally, using loans effectively. And we're going to talk about that in the context of investing and kind of what that does for people's wealth over the long term. But I know you guys service so many clients at Everest. I know you service so many of the Rask community as well. My first question on this is not necessarily about the topic itself, but like how common is the use of debt or leverage, just generally speaking, amongst the Everest clientele? Like if I said, like, here's 100 of the most recent Everest clients in a room, how many of them would use this type of a strategy?
Yeah, so it's definitely talked about a lot, but I guess probably it's not implemented that much necessarily either, because it does require, I think, a specific set of circumstances to be applicable. So definitely using equity is quite common. So clients that have come to us and they bought their first property and maybe they've had it for the last 5 years or something like that. So generally speaking, they would have made some money off that. So there will be some equity now. So that conversation is typically around maybe using that to then get them into their next PPR as an example. That's common. Along with potentially drawing that out to then potentially invest elsewhere, so maybe another property or into shares. And then debt recycling does occur a little bit within that as well, and is definitely in the conversation. But if you were to try to put some numbers of it, if you say it was the last sort of 100 clients, maybe 10 or so we would have gone for a debt recycling sort of style situation, equity release, maybe 20 or something like that. And then, I think you've mentioned here as well, like a leverage style investment. So like ETFs that are geared or something like that. That's a conversation that we're having more and more these days. And people that are coming to see us are a bit more educated around it as well. And so it's having that chat around what you can sort of do in that space too. Definitely.
Because we spoke about that not too long ago. The last time we spoke, actually, I think was on the topic of like the beta shares range of leveraged ETFs that they came out with not too long ago, like the lesser leveraged ones. Full disclosure, beta shares, sponsor of the show. And obviously these types of things that we're going to talk about today do appeal to, like you said, to a particular subsection of the population, like depending on risk profiles, like your asset base, your income, like so many different things that come into play here. So let's start at the top. Let's start with like debt recycling 101, mate. So for someone that's like brand new to it, what is it?
Yeah, so this is I think this is like key, right? Because this is definitely the mistake I see on a lot of like forums, like Reddit or Facebook, sort of finance groups and stuff like that, where people are talking about this. So what it is think about recycling, right? That's probably the key thing. So you drink a bottle of Coke and you put it in the recycling bin, and then that plastic can be reused again, right? So they're not creating any more plastic; it's being recycled. So that's what we're doing with the debt, right? That's the fundamental key part to this strategy. Is you're not creating any more debt; you are recycling it. So take say you have a $500,000 loan. Okay, basically what you're looking to do on say a principal place of residence, what you're looking to do is to turn the interest on that loan from being non-deductible, because you can't claim the interest in your tax return for the house that you live in, to becoming deductible. Now, interest is deductible on loans that are used for revenue generating purposes, i.e. investing in shares, ETFs, property, for example, but you're not adding any more debt. So this is where people get confused a bit. So that would be gearing. So using equity, say in your house, to take out a loan to then invest into shares that's adding to your debt, right? So that's actually a gearing strategy. Now, whilst it is very similar in terms of, I guess, what you're sort of implementing in the debt recycling strategy, you are actually adding debt, whereas debt recycling is adding no more debt. It's simply just recycling that debt from being non-deductible to now deductible.
Okay. So someone's got maybe example here would help. So someone's got a home.
Let's just use 500,000, right? To me, that's a pretty. I mean, I know my mortgage is a bit more than that, but let's just use 500,000 as an example here. So you've got a loan of 500,000. You've got $50,000 in cash. Okay. Mm-hmm. Now, what you decide to do is you pay that $50,000 into that loan. Okay, so now your loan is $450,000. But you have what's called a redraw facility attached to that, which allows you to take that 50 grand back if you want. You then decide to pull that back. The loan is now back to 500,000. But with that 50,000, you now go and invest that in, let's just say shares in this example, okay, which is a revenue generating asset, which now means 50,000 of the $500,000 loan is now tax deductible in that example. Your $50,000 cash is gone, okay, because that went into the loan, then it's come back and that's gone. Okay, so your loan is back to 500,000 exactly as it was before, but you've been able to turn $50,000 of that into a deductible loan, and the other 450 is still part of your PPR. So that's effectively what debt recycling is. You're slowly recycling that loan from being non-deductible to deductible.
I like how you use the Coke bottle example. A lot of people can get around that.
Yeah.
So let's
you a Coke or a Pepsi man?
I'm probably a Coke Zero type guy, to be honest. Yourself?
Pepsi Max.
Oh yeah, I was Pepsi Max, but then they came out with this new formula. I don't know what's in it. I don't think anyone does, but I like it.
They did change it, didn't they?
Yeah. Let's peel back the layers on this overall. So, if someone like one of your clients was using this strategy, what are the types of investments that they're making? So you mentioned shares and ETFs and property. Like, what is typical?
Yeah, so generally with debt recycling, you are looking to normally invest in shares or ETFs, and generally you'll go for maybe like an ETF that has a higher yield, so it has a higher income component. So Australian shares, for example, tend to pay a lot higher dividends than other shares sort of worldwide. So that is attractive for two reasons. Firstly, that additional sort of income component, which typically comes with those shares, helps service the loan. Okay, so you're getting more effectively, income to help pay your debt. And then secondly, Australian shares come with a franking credit as well, which is effectively a tax credit. Now, what that is effectively the companies have paid tax at their tax rate. Okay, so 30% odd. So what that means is when that income comes to you, it comes with a tax credit of 30%. So you don't then get double taxed in that example. If your marginal tax rate is above 30%, so say it's 47.5, you effectively pay the difference, pay the top up. But effectively, if you say your rate is 30%, then there will be no more tax to pay in that example as well.
Yep, that makes sense. Okay, so we're looking for income producing or revenue generating investments there. So now let's talk about one other aspect of this, which is obviously you mentioned it at the top of the show, is like, who is it suitable for? Like, a lot of people would talk about this like in an online forum or like a Facebook group or Reddit, or even with their friends and family. Like, they would maybe think that it's an idea that they could pursue, but it may not necessarily be right for them. You've got a cross-section of hundreds of clients that you've worked with. Typically, who are the people that are considering these types of strategies, or this debt recycling in general?
Yeah, so I think, with debt recycling, you've obviously got to have a decent investment time frame. So obviously, sort of 10 years kind of minimum. 15 years, I think, is sort of preferable for this to work. And it can get quite messy potentially as well, right? So you've got to try to think about what you're basically doing from a home ownership perspective. So what I'm talking about there is, if it's your first home that you're potentially thinking to sell at some point to upgrade because you're then going to start a family, or you want to then keep that as an investment property or something like that, then it may not be a good time to potentially start a strategy like this, because you might only get a couple of years in and then you've got to unwind it, or it just becomes, again, it potentially shoots you in the foot of getting that upgrade to that next house that you want. But once you've kind of potentially got into like the family home, and you're thinking, ideally I am going to stay here for the next sort of 10 to 20 years, that I think is a good time to potentially start exploring a strategy like this, because again, you've got that time frame. You're not necessarily going to stuff up any other future plans by commencing something like this, because it doesn't happen overnight, right? It's a recycling. So that 500,000 that we used before, that would take a number of years, right, to eventually get that full 500 to now being deductible debt as opposed to non-deductible. So that's the thing first and foremost. You've got to be comfortable with leverage. So you've got to have a pretty high risk tolerance, because you are effectively borrowing money to invest. So it's a lot more risky than just simply investing money with cash that you've already paid the tax on. There's no borrowing attached to that. Attached to that. So you've got to be comfortable with that as well. Stable incomes are pretty important. Like, you've got to have the cash flow as well. So you've got to be able to produce enough surplus on your bottom line to be able to put extra money into the loan to then be able to pay it down to then draw it back as well. That's obviously key. So if you're, it's obviously pretty tough out there with the cost of living and stuff like that at this point in time. So if you're only sort of just keeping your head above water, or, you're not producing that much of a surplus income on a yearly basis, then it's probably not worthwhile doing a strategy like this. Furthermore, from the practicality point of view as well, like, you can do it like with $1 in theory, right? But like, I probably wouldn't bother unless you're doing it in sort of 50 grand chunks as an example, sort of as a minimum, because there is a fair bit of paperwork and admin which goes with all of this as well. So you've got to be, again, just in a position that you can pay into the loan quick enough to sort of get these big enough chunks that you can then basically execute on this as well. So yeah, those would be some of the things I would sort of say. Would you agree with those?
So we've got, like, you have to be comfortable. Like, one of the things that you mentioned there is like comfortable with the loan. Like, I find that a lot of couples in particular, one might understand this, but then the other one in the couple, all they think about is like paying off the mortgage and debt, and just see like bigger loan balance is a bad thing for them. And so understanding and listening to them is really important. But that is definitely something that I see a lot. Stable incomes. Absolutely.
That's a good point there. If I can just interject. Yeah, so, yeah, because you're right. Because what you're doing, right, is it's not necessarily bigger loan balance, but it's extending that loan balance for a longer period of time.
Yeah.
Yeah. So it's you having that $500,000 loan balance until it's in theory completely recycled, and now it's completely completely now deductible, and then you pay it down. So that is going to extend it out much longer, which is then from a lifestyle perspective, potentially committing yourself to working longer, right? Because you need to service this thing.
Yeah, good point. So they just see that. So that's a really good thing that you touched on there. I think that, like, if we invoke our Charlie Munger here, he would tell us to talk about the moments when you shouldn't use any type of strategy like this, like debt recycling. So if we know that we're going to need cash flow, maybe one of the things, Alex, might be, well, if you don't have the full amount of cash flow right now, it's maybe something that's not right now. Are there other things that you would throw into the list of, probably not right now or no deal at this time?
Yeah, I think coming back to, I guess, as I said, like who it's right for, like you've got to be, and life is dynamic, it changes all the time, right? But you've got to be pretty comfortable, I think, in what you're going to do over the next 10 to 15 years, which, look, might not happen until you're sort of in your mid-30s or you're 40 or something like that, when you've got potentially, again, that family home. Because it doesn't mean you can't start this, by the way, earlier with a home and then sell it and change and stuff like that. But again, it just makes it messy. Like, ideally, you recycle all the debt or a portion of the debt on the loan, and then, pay it down, and, you've walked away with, the example before, assuming no growth, you've got a paid off mortgage of $500,000 plus you've got a $500,000 share portfolio as a result. Yeah. But that, again, I guess, not to sort of harp onto it too much more, but it takes time. So you've got to try to be, just stable in your life as much as possible, I think, is so where I typically see it making sense. If I can give like an anecdote, I guess, sort of example is, potentially people, that they've had a couple of kids maybe, or they've got a couple of young kids now, but now both people are back to kind of working full-time or close to full-time. They've got the family home, and look, we're staying on the leafy street, in the cul-de-sac for the next 20 years with the big family home. That's what we're going to do, and we're happy with that. And mum and dad are both, happy to work full-time over that period of time as well, because they enjoy their careers or whatever it is as well. So those are things I think you need to sort of think about a little bit before you sort of start something like this, because, jumping into it from sort of a knee-jerk reaction, or simply because, like you said, it's the hot topic or it's trending.
Yeah. It's like one of those, what is it, the one-way doors, like you want to be slow to go through, not to say it's a one-way door completely, but once you make that decision, you kind of commit to this long-term wealth creating strategy.
You kind of got to, I think, like, you don't have to go all the way, like you don't have to recycle the whole debt or anything like that, but like, doing 25 grand or something like that, like it just doesn't make it for the effort and stuff like that. It just doesn't make any sense. You kind of want it to be, at least a couple of 100,000 to sort of make this worthwhile. As I said, there will be a fair bit of additional admin and stuff which comes with this as well.
Yeah. Now I'm going to change gears a bit, mate. I did ask if you could just prepare like a little, like table or spreadsheet or whatever on this. So, for anyone that's really engaged and listening to this in audio only, if you're driving, don't obviously get the video up. But if you've got the chance to just switch over to the video version, there's a link in your podcast player. You can jump onto the YouTube channel and fast forward to this moment, which is roughly 20 minutes into the chat. And Alex is also going to try and walk us through his table. We know podcasts aren't great for numbers, so we're going to try and walk you through it. But mate, what have you put together for us here?
Is there a way we can bring it up a bit larger?
Yeah, can you zoom in on your end, mate?
Yeah, I've got it here. So what I've tried to give here is, again, a very generic example, okay, and which then hopefully people listening I can sort of talk them through it as well. So what we're looking at, or the assumptions here is, again, a $500,000 loan at a 6% interest rate in this example, and this person earns $200,000 a year, so the top marginal tax bracket. Okay, so they're going to get the most benefit from the tax deductibility of the interest. This still makes sense, by the way, if you are on a lower income as well. But yeah, the more money or salary money you're sort of making, the more this potentially does make sense from that perspective. The $500,000 loan, so they're paying about $36,000 a year in interest repayments, and effectively we've assumed they've got around $46,000, $50,000 left over of surplus, okay, which effectively we're going to then they're going to take and they're going to put into this loan as additional repayments to effectively get the loan as close to $450 as possible. Mm-hmm. So they go and do that. They then take the 50 grand back, which we've talked about before, and they go and invest it. And in this example, we've just assumed they invested into Australian shares or a high yield ETF with Vanguard or Beta shares, something like that. Some sort of diversified portfolio within that ETF, which is going to produce more income, preferably. Yep. So they do that. So then, what's their position then in year two or year? Yeah, this says year one. So, but yeah, year two, right? So what does now it look like? So they're getting some dividend return, okay, so from that 50,000. So we've assumed sort of with the franking credit, they're getting about 4%, okay, so they get some income from that. Their loan repayments haven't changed, okay, because it's still a $500,000 loan in this example. So there's no change to the cash flow from that perspective. But now because they're getting this additional income, their surplus has increased as a result. So in this example here, if you're listening, it's gone from about 46,500 to 49,500 odd as a result. So they actually now have more income as a result of this, and they're getting a tax deduction for the interest as well of about $3,000 for the interest that they're paying on that $50,000 portion of the loan.
Alex, can you just scroll down just a touch for just a little bit? Yeah, there we go. Perfect. Yeah, great. Okay, so yeah, it hasn't really changed that much.
No, it hasn't changed a great deal because $50,000 is obviously a lot of money, but if you're only getting 4% on that, it's not going to be life changing, right? Which again sort of comes back to the point of doing this for a small amount doesn't really make any sense, I guess. Again, it's better to sort of commit and go the whole hog where possible. Yep. So then fast forwarding though then to year 10 in this example, okay, so what that is then doing, so the loan is now the same because we just assumed they've put 50 grand in every year, by the way, and then redrawn it out as part of that. So now they've got a $500,000 share portfolio, assuming no growth over this period of time too, which is then producing them 4% as before. And they've still got their $500,000 loan on the mortgage, but now the entire thing is tax deductible. So they're getting about a $30,000 tax deduction as a result. And then they're receiving income now from the full $500,000 worth of their share portfolio, which as a result now in terms of their bottom line has increased their surplus income from $46,000 or $46,500 after tax approximately to now around $75,000 as a result.
Can you just scroll down just a touch again? So basically what we can see here, thanks mate. So what we can see here is basically at year 10 for folks that are listening is the dividend income and like the franking credits has risen to say 30 grand. And that's roughly offsetting the loan now because that's the whole point. But you made a few critical assumptions there. Like you said, like we've assumed like in this instance, the loan hasn't like the portfolio, we haven't factored that in here. That's probably grown a bit. Another thing is this, the salary is still 200 grand here. That's probably going to go up a bit too. So there's like a lot of like kind of like those, I wouldn't say hidden, but maybe those subtle things that also kind of skew in your favor when you start to think about long-term wealth creation in this regard. In addition, you've obviously got the 500,000 as well sitting there. So
you've made a great point there, which I forgot to touch on, which is effectively, in year 10, right? The income coming in now from a cash flow perspective is almost covering the mortgage payment.
Yeah. So
that's pretty powerful, I think.
That's hugely powerful. So now we're starting to see, well, hey, you're getting further. You're going to, you've got a few things you need to put in place over the next few years, but you're starting to see the true powerful benefits of this by year 10 really kicking in. And this example kind of hits that home. But then, like you said before, 10 years is great, but if we can go longer and longer and longer, better again.
Yeah, that's right. And this sort of comes back to what we were talking about before, like who this is suited for and stuff like that. Generally, you kind of want to have, a minimum 10-year time frame for investing in general, right? But generally, you need to see sort of 10 years before that snowball is big enough that you start to see like the true kind of benefit of this as well.
Just a question on this for folks that are like, because I put this in my email the other day. Like, I think it's really important to get professional advice when you do this. I feel like seeing this on the screen here, and for folks, I know not everyone's watching, but you can see it all in the Word doc that Alex has put together. I feel like this is really empowering for people because now all of a sudden they go, well, if I get this right, I pay for advice or I get advice or whatever. There's a lot of value to be had here, even though it's going to cost me, out of pocket to pay for my expert support. I guess my question would be, in order to do this, who does someone listening to this or watching this need to reach out to? Like, obviously you're a financial planner and you'll do this with them. Is there anyone else that they need?
Yeah, so I'm a financial advisor. I'm obviously going to be a bit biased. But I think sitting down with a financial advisor first and foremost is the key to run through, these cash flows or these hypothetical cash flows to make sure it is going to make sense for you. And also, I guess a big thing or big value add I think that a financial advisor does is they should take a holistic view. So it's also about your other goals, right, as well. So to make sure that doing something like this isn't going to impact something else that's really important to you. So I'll just chuck that in there. Yeah. But in terms of the other professionals that you should engage or you do need, is a mortgage broker, because then they can help, like I said, with that paperwork and that admin around making sure, getting that loan out or that equity out so that you can effectively invest that. Because ideally, you break it off as a separate loan as well, that you don't leave it in the existing home loan and simply pull the redraw out again, because it's very messy. So ideally you pay 50 grand in, again, to keep using the $500,000 loan example, and then you break off a separate $50,000 loan, which is then invested. And then again, it's very easy to sort of track basically the interest on that, which is where you would, I would definitely encourage that you, if you're not already, engage an accountant to help with the tax return on that as well, just to make sure everything's being claimed correctly too. And one more probably plug for me and my profession, I guess, is what we've done here in this example, right, is that income, well, if we're using shares or dividends, it doesn't come through like on a weekly basis, right, or a fortnightly basis. So it might be quarterly or half yearly as well. So you've got to make sure that as soon as you start that, you're not going to get the income the next day to help pay with, next week's mortgage repayment. So you've got to just again, cash flow that out correctly and make sure you've got appropriate buffers in place to sort of see through the periods where you're not getting that dividend income throughout the year as well.
Yeah, that's a really good point. Okay, so I might put the screen away now, Alex, if that works for you.
Yep.
Cool. So I've got a couple more questions before we wrap this up, because I know like people can just book in with you. There's a link in the show notes and your team at Everest. I guess one of the questions that I have is like the mistakes and risks that people make. Yeah, so the risks that they face and the mistakes they make. So probably two different questions, but like what mistakes do you find people making when they do this?
So I did have some good stuff on my notes for this. Let me just check where that was. Yeah, so I think let's start with the risks. Okay, so and we've already kind of touched on these, so we won't spend too long here. But yeah, I think the first risk is commencing a process like this without considering the appropriate time frame that you need. So sort of that 10 to 15 year kind of minimum. They're not considering how this is potentially going to affect other goals. So i.e., you wanted to retire at 50, but then you've done this and then you find yourself at 50 with still, say, a $400,000 mortgage or something like that, because you are going to extend out your repayment time frame. So thinking about that. Not really properly considering their own risk profile. So we are leveraging. So we are magnifying, returns and losses as a result. So we're taking, for lack of a better word, a bigger bet, okay, as part of this. So making sure you can stomach that. And then I guess as well, as much as possible, like that job security and stuff like that as well. So if you're in a really high paying, stressful job, and then your plan was in 5 years to go and do something part-time or a bit more chill or something like that, but then you're sort of, halfway into this debt recycling strategy, again, that might potentially stuff that up. So as much as possible, I think, you're not going to be able to control everything or anything like that, but just having some forethought, I think, will really go a long way to make sure that you are, as much as possible, not going to sort of shoot yourself in the foot. Would you have any to add?
No, that's probably what I'd say. I think there's like a risk that someone takes this money, maybe from a behavioral aspect, and kind of gets it wrong in terms of like them or their partner might use it for something else, or the investment might be a pretty cruddy investment, to be honest. Like, does it produce income? Is it an actual bona fide investment? Yeah, that's probably I just want people to be really careful. And that's again why getting support with something like this can help. How about then in terms of other mistakes?
Yeah, so mistakes. So I would have, it's a risk as well. I had a mistake, but like, as you've said, just like picking the wrong investment. I've seen that. I've seen people get the equity release and then put it into non-income producing things and stuff like that, or just I've seen someone put it back into their home loan. So I've had that before, which and again, they're a pretty smart person, to be fair as well, but they just they don't work on this field and they don't have again, they just sort of did it unadvised. Not saying that obviously I'm a financial advisor, so I'm plugging financial advice per se, I'm biased, but you can definitely do it without a financial advisor. But a lot of people do. They just don't understand one part typically, and believe it or not, that then the whole thing sort of collapses as a result.
Yeah.
So that person, they didn't know. They were like, I can just pull it back. I'm like, well, no, because now you've changed the components again, so you've kind of stuffed it up. So seeing that, double check this with your accountant. But so say the mortgage is in joint names, so borrowing so getting the equity release as part of that, but then only investing into one individual's name. So that potentially stuffs things up as well. So I've seen that a few times. Again, anything I say, double check with an accountant as a caveat, but that's going to stuff up part of the interest deductibility, I believe, in that situation. And that's quite a common thing, right? Because most people have bought a house together, and then maybe one person is working way more than the other person because the other person's the primary carer or something like that. So they just go and invest in their own name. Or as you mentioned before, a lot of the time, opposites attract. So one person's super keen on something like this and they go ahead and they do it. And yes, they got the partner's approval per se, but then they just went and put it in their own name because they're like, I'm the one doing it, without, again, sort of realizing that they may have stuffed that up. So that's pretty common. And then, I think just some of the other things that we've already really touched on, like too short a time frame, not being able to commit enough money to really get that snowball effect. And then obviously, this would be pretty rare, but if you were on very like the lower tax bracket or something like that, again, it makes less and less sense.
I was going to say that's one thing, like you said before, people pull their money out. Then the next decision, they're like, now we invest with the person who has the lowest tax income. And then you're like, wait, but this is not what that's about. So, okay, so just a couple more questions there. One is what can people do to minimize those risks other than reaching out and getting in contact with people like accountants, mortgage brokers, qualified financial advisors, etc.? I feel like one thing, and we were just talking about this off there actually, one thing a financial advisor can do is help with insurance, which I feel like is really important, but particularly when you go down this path.
Yeah, absolutely. And that's, again, I guess that holistic approach that a financial advisor should take. So it's cool. All right, we want to do this debt recycling strategy because it's going to build our wealth in the long term, and then the numbers are making sense. But then it's not just double checking to make sure this doesn't interfere with other goals, but it's along with what protections do we have in place as well? So do we have a solid cash buffer, as an example, to give us some short-term coverage? Do we have potentially some personal insurances in place as well, like life insurance or income protection? Particularly from the life insurance perspective, if you're doing it with a partner, which most people will, because again, we're extending this load out for a longer period of time as well. So there is going to be a liability held for longer than usual if you just paid it, as per normal. So those things are very important to make sure you've got that wealth protection plan down patted in place as well before you commence something like this.
Yeah. I also think I'm going to just get a particular plug-in for long-term investing in ETFs. If you're going to go down this path, you might back yourself as a stock picker or whatever the case may be. Just do that somewhere else. Don't let it interfere with this long-term wealth creating plan, which I think ETFs are a safer way to use a strategy like this rather than, individual stocks like we would have seen 10 or 20 years ago. So that's probably one thing that I would say. And just have a really open dialogue with your partner, mate. So we've talked about tax agent, financial planning, or financial planner, sorry, and mortgage broker. Someone's listened to this episode. We've obviously given them a crash course. This is not personalized financial advice. So if someone wants to explore this in detail or go down the debt recycling path, what are the broad steps that someone would take now?
If they're not going to get advice first, if they're going to do it themselves?
Well, maybe if you say from a non-advised person, what are the things that you would do versus obviously I feel like getting advice first is probably for someone that's inclined to do that is the best thing to do right now. Yeah. But then for someone that is going to just explore the topic, let's say, what would be required of them?
Yeah, so first and foremost, you'd want to make sure you generally have a good understanding of what this is. Because as I sort of mentioned before, there's a lot of smart people on Reddit and these finance forums and stuff like that. But even when I read their comments and stuff like that, again, they're missing something fundamentally more often than not. So you do want to really make sure you genuinely understand what this is and how it works first and foremost. And then you want to put those other things in place that we've already kind of mentioned as well, that you've got the time frame, you've got the surplus cash flow, you've got your partner on board. This isn't something that it's just the flavor of the month and you're going to try for 6 months and then stop, because again, as we've sort of said, there's not a lot of point in doing that. You do kind of need to be committed for the longer term. I think it's a great point you made before as well around what investment is also chosen. You're already taking a lot of risk by borrowing the money, so why would you add even more risk unnecessarily by trying to pick the stocks yourself? Or I've never seen anyone do this, but borrow and then go into a geared ETF on top of that or something like that, unless, I don't know, you've got an insane risk tolerance or something like that. So yeah, I think it's those sorts of things, and then having a chat with your mortgage broker. So just understanding practically how you can do this, because you can't really, unfortunately, just sort of click your fingers and this happens. So you don't need to either speak to your lender and figure out how you're going to be able to do this practically, or speak to your mortgage broker and get them to sort of assist you, because that's, I think, a really important thing as well, along with, as we sort of said, like the common mistakes. Make sure when you get the money, you don't go and invest in the wrong person's name or put it into something that's non-income producing or something like that, because that, you just shoot yourself in the foot there as well.
Yeah, just one. It's like a link in the chain. Like one of those links breaks, the whole thing's works.
Yeah, and I think like once you've done it, there's no reason why you couldn't then continue to potentially handle it yourself. Like it's not rocket science at the end of the day by any sort of means, but there is, like you said, a few kind of fundamental links in that chain that if you do stuff one of them up, like it's a lot of money. Like, borrowing 50 grand is a lot of money. Like, at the end of the day.
Yeah, absolutely. So there's a link in the YouTube description or podcast player, depending on where you're hearing and seeing this. Click the link and you get matched with a financial advisor. You can find out more on the Everest Wealth website as well. So I'll put all the links in there to go about your business and to learn more about this. I think for most people, when I say younger, I mean like people that are accumulation phase. That's what we call it in financial planning lingo, which means that you're building wealth. I think this is something that if you do own a home, you meet the criteria that we kind of laid out generally before. Explore it, understand what it means, because there's not many really good strategies that are just worth contemplating, I'd say, and this is one of them, depending on your life stage as well. So, go and explore it, get in contact with a financial planner, because the reason why I'm pushing this so hard, Alex, is because it's not just because there's risk for you and I talking about this, because it involves debt, it involves tax, it involves financial planning, it involves a bunch of other stuff, investing. It's just it's also just one of those areas where I think it makes a lot of sense to get the right advice because it's so fruitful.
And on that, sorry, before we get to the final question, one point we probably haven't quite touched on, which you did there somewhat, is I think, again, this is becoming more popular because a lot of people don't necessarily want to buy an investment property or have heaps and heaps of investment property. So this is a great potential alternative that you can still have your own house, but still be, having your equity or your capital working as hard as you possibly can. So that's where I think this has gathered a bit of steam that, you and I are obviously from the same generation, that because I guess the prices of property and maybe ethically you don't want to have an investment property or whatever it is, that's why I think as well this is starting to get some more traction. It's something that's been around forever, right? But it's just starting to get a bit more legs, I think, from that perspective. And as you just said, it's a great alternative as well to build wealth. Yeah,
definitely here in Victoria. Well, I'm recording this from Queensland right now, but definitely in Victoria, my native state. People just are so fed up with things like land taxes, different costs associated with investment properties. And other than maybe the vanity metric, to be honest, to be frank, people are more familiar with property than they are with shares and that type of stuff. But I think the next generation is going to be more familiar thanks to things like ETFs and the ability to have these conversations and listen to them and see them and stuff. So, I think that will be a bit of a shift in people's awareness of what they can do. My final question is it doesn't have to be related to debt, recycling debt in general, property, share. It doesn't have to be, it could be whatever you want, mate, but it could be totally up to you, as you know. I like to ask you these types of questions, which is if someone's watching this, someone's listening to this, what's one thing that they can do right now? What would you tell them to go away and implement or to think about? Just one thing.
Yeah, perfect. So I had a bit of a think about this before. So I thought I'd just make a bit of a contrarian comment per se, in that obviously we've talked about, this strategy, which is, leveraging yourself up and whatnot and taking on more risk. But at the end of the day, it's not for everyone as well. So if it's not for you, provided you start early enough and you educate yourself enough, you're able to still build a really solid foundation or build really significant wealth simply by using your savings and investing as well. So I don't want anyone listening to this being like, oh, that sounds quite risky and I'm not confident doing that. That's fine. I was listening to the audiobook the other day, Strong Money by David Gow. Who I know you've had on the show before, and he touches on this very briefly in his book, and basically his point was, you can do that, and you will potentially build more money, but you may not necessarily need to have that as well. So I don't want anyone to feel like they're missing out if they're not comfortable doing a strategy like that. We can simply just pump existing surplus into investments as well, and generally you're still going to be able to achieve what you want to achieve as well.
Yeah, and like you said at the top of the show, there's so many different ways to go about it. This is just one of the kind of little slithers of this part of the world of financial planning that you guys deal with. So there are so many other things, like so many other strategies that people can pursue. So that's a really good note to leave this on, is like there's a great overview in this episode of what it is and what it isn't, who it may or may not be applicable for. And you used a really good example there, Alex. So I really do appreciate you coming on the show yet again to share this with us.
Thanks, mate. Yeah, it was really good fun.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.